So now we're moving into our discussion of macroeconomics. We've been talking about microeconomics all semester mostly, and we're gonna think about um, the economy as a whole. So we're gonna talk about things now uh, that you probably read about or hear on the news about gross domestic product, what is happening to GDP. We're gonna talk about the circular flow and how that fits into measuring GDP. And then finally, we're going to talk about the difference between nominal and real GDP. So, the textbook definition of GDP is the dollar value of all final goods and services that are produced in a country in a given time period. Notice there are some important words here. One is final goods and services. We have to be sure that we don't count in GDP intermediate goods. That would give us a measure of output. We're trying to measure output here. We're trying to measure the value of our economic activity, and if we counted intermediate goods, we would get a result that was much bigger than reality. So if we think about all the parts that go into an automobile, Goodyear produces tires, and those tires might be sold to Ford Motor Company. And if we counted the value of those tires once when they were sold to Ford Motor Company, we would be counting them twice, because we would count them once again when the Ford Motor Company sold the final output, which is the car. So we have to be sure that we're only counting final goods and services. For GDP, gross domestic product, we only count things that are produced within our country. So we have some things that complicate this. We have other measures of economic activity, like gross national product, GNP, net national product, NNP, and those types of things. These are complicated by things like ownership structures. For example, we might have a firm that is we might have a factory that is owned by an American company but is located outside our country, which would be counted in some of these measures and would not be. If we're in Tennessee, we have a Volkswagen plant that is a German-owned company. So the ownership doesn't matter. What matters is that the output is produced here in Tennessee. We have famously, Apple produces all iPhones and iPads in a factory in China, and some of the components come from the United States. For example, the Corning company makes the glass for the front and back of the iPhone that is sent over to China and then assembled in the plant there. So even though American companies are manufacturing components for that, those are things that don't fall into our GDP because they're not produced here. So if we think about our economy, there are two main actors. This is called the circular flow model, kind of a basic model of how our economy works, kind of the interactions of all the micros, economic decision makers that we talked about. We have the households on one hand. The households are owners of resources. They sell those resources, and the resource markets are here called factor markets, to businesses. So you live in a household, you own your labor, at least you sell that labor for a wage in the resource or factor market to a business, and the business uses that to produce a good or service that is then supplied in the product markets. So we have these interactions in the factor markets or resource markets, where businesses are the buyers and households are the sellers. Then we have the same groups of people interacting in product markets, where the businesses are selling their products, their goods and services here, and households are the demanders here. They're the buyers. And so we have this model where there's a circular flow, and they say it's circular flow because of how the money flows, right? The money flows from households through product markets to business firms. The business firms spend that money on resources, so it goes back to households, right? They pay the wages of their laborers. They pay profits to stockholders. They pay profits to the entrepreneurs. They pay landowners for use of their land and so forth. And so we kind of get this flow of funds and flow of resources and goods that goes in the opposite directions. This is a nice kind of little synopsis of what our economy looks like. Even though there are millions of households and millions of businesses, we're kind of lumping them all together and looking at them. And remember that every person that is working as a manager, decision maker in a business, or working as a laborer, or someone that is somehow involved in a business, is also a person that is involved in the household decision making too, right? So there are people in both of these kind of bubbles here, and they are the same people interacting with one another in their different roles. So this is all nice and neat with a nice little circular flow with two kinds of decision makers and two kinds of markets. Obviously this gets complicated a bit. We have things that aren't in here, like, well, when the business pays a wage and for labor, that the households get taxed on that, right? We have an income tax. So not all the money that businesses pay out for labor makes it to the household. Some of it goes out to the government. Some of the money that households receive as income is not spent in product markets, but is saved for future consumption, right? We save when we are young so that we can hopefully retire someday, and so we have savings that comes out of here. It doesn't all get spent, perhaps. We also have some businesses may produce things that are sold to households outside the United States, right? We have exports, and we have some things that are purchased by households that are not manufactured in the United States, and so we have imports, and so all these things complicate this a little bit. But when we're thinking about this as a measure, as how the economic activity is, this side right here says, this blue thing says expenditures, and which is going to be equal to GDP. So we get from this circular flow the idea that we can calculate GDP, or economic activity, by adding up all the expenditures. Because we have those things like taxes and savings that complicate this, we have to have not only expenditures by households. Consumption expenditures is that money that's spent, that income that's spent in the goods and services market. We call that consumption expenditures. We add to that investment expenditures. So usually we say that what leaks out of that circular flow as household savings is injected back in through private domestic investment. So this is investment. This is purchases of capital goods and long-term durables, like homes would be included in investment. Like capital goods like machinery used in the production processes. Purchases of those things are called an investment. So we have a financial system that works to translate those savings by households into investments, so they're injected back into that circular flow. We all know that governments spend plenty of money, so that leakage of taxes, the income taxes that never make it to the households, and the sales taxes that never make it into the firms, or those kind of leak out of that circular flow as taxes and are injected back in as government expenditures. And then finally, we kind of net out exports. So we have some things that are produced here and sold elsewhere. We call those exports. We have things that are produced elsewhere and sold here, and those are imports. When we're calculating GDP, we add up consumption expenditures, investment expenditures, government expenditures, and then finally net exports, which is export expenditures minus, or the value of our exports minus the value of our imports. So that gives us a measure of economic activity in our economy. We know that this is not a perfect measure of economic activity because there are some things that can't be included. Non-market transactions. So my wife and I might hire a babysitter to come watch our kids, and so we might pay up to $10 an hour for a babysitter, and this is a cash transaction that would not be recorded in GDP. There are other things. When we decide to cook dinner at home instead of going out in a restaurant, the same exact meal might have a much lower value from the grocery store. My cooking dinner, or me or my wife cooking the dinner, adds value, and these are things that are not picked up in GDP. So you can see $10 worth of groceries might cost $50 at a restaurant, and so that would lead to kind of drastically different measures in GDP from the same meal because that non-market activity of preparing the dinner is not counted. The kind and quality of products are not accounted for in GDP. If you think about trying to compare GDP in 1982 to GDP in 2012 or something like that, that 30-year difference, the dramatic difference in quality of things like automobiles and computers and cell phones and iPods and things that couldn't even be imagined in 1982 that are being bought and sold today. It doesn't count leisure time. The value of taking time in non-productive activity is not accounted for. So while I may find a great deal of value relaxing on my back porch, it's something that's not picked up in GDP. We have the underground economy, so things that are illegal are traded a lot. We know that in the United States there's a great deal of illegal drug trade, and none of that is counted as productive activity in GDP. Even though apparently some people find value in illegal drugs, these transactions are not picked up by GDP. And underground economy that may be because of tax avoidance. So it can be not only illegal activity, but it could be just maybe I buy something from someone on eBay and don't pay sales taxes on it or something like that. These things might not be picked up. And then finally, we don't subtract off for things like negative externalities like pollution and so forth, something we might call economic bads, loosely phrased. We don't, if you notice, imports were subtracted from GDP in that GDP equation, but nothing else is subtracted off there. We need to make a point to mention the difference between nominal and GDP, or nominal GDP and real GDP. Nominal GDP is measured in that year's prices. What we've seen over time is a general overall increase in the price level that we call inflation. The difference between something nominal and something real is that when we say something real, like real GDP or real income, so forth, these things that are real have been adjusted for inflation. So that's what we care about. We don't really care about the dollar value of how much things cost. What we care about is how much we are actually producing. So real GDP, which has been adjusted for inflation, gives us a better measure of that. So because prices tend to increase over time, adjusting for inflation gives us a real idea of what's happened over time when we compare real GDP. And it might be, and probably is, more appropriate if we're thinking about the well-being of a country, to look at real GDP per person, because a country with many more people might have a higher GDP, but the share that goes to each individual might be somewhat smaller. If we look at this table here, the base year chosen by the person presenting the information is arbitrary. They happen to have chosen the year 2000 as their base year. So that means that they have used the prices from the year 2000, to compare output from the years 1960 all the way through 2010. And so there's one point in the year 2000, because they use the prices from the year 2000, or the price level from the year 2000, that real and nominal GDP are equivalent. So it's important that when we think about how growth is, or how our country's economy has grown, that if we look at nominal GDP that uses 1960 GDP would use 1960 price level, it looks like we have a very steep growth pattern. But if we adjust for changes in the price level here, we see that the real GDP has grown at kind of a different rate, a slower growth rate, right, as we see a much flatter curve there depicted in this graph. Alright, that's it for Chapter 11, so get to work on that homework. Thanks.